From Austin to Amsterdam. Thank you for being here. Welcome back to another edition of Down the Middle. I'm so excited today to bring to you a rising star on Twitter, somebody who's revolutionizing how we take in analysis to help us find how we're going to be positioning our portfolios. A fellow Paisan, I bring you Alfonso Peccatiello. He is the founder of the Macro Compass, but much more importantly, he used to run $30 billion. And that's really, when you're talking about who do I listen to, who are my go-to experts, you want somebody who has run money and at the same time also knows macroeconomics. So I bring to you the best of both. Very happy to have him with us today.
It's my pleasure, Danielle. Really, big times being here. It's an enormous honor.
Well, okay, your last name, Peccatiello. So there's a little bit of history there. We're going to do a little bit of geography here because I'm a paisana, okay, and I can call myself that. My grandmother was from Naples, and she had a temper. Boy, did she have a temper. But she taught me how to cook. Everything I know how to cook, I learned from her. My grandfather was a very calm man from Guardia Grelle, which is in Abruzzo, close to Pescara, Chieti. And in 1786, my family moved to this town from San Martino. So the only reason I know this is because I went and visited and saw the cornerstone of where my grandfather was born, and the house and the vineyards and everything. And I made the mistake of saying, well, they're from San Martino. That's where di cecco pasta is made. And they said, no. You call yourself an Italian. It's di cecco pasta. So when people are always like, it's di cecco pasta. Exactly. People are always like, so where are you from? And I'm like, I am from San Martino, where they make di cecco pasta, because that's where my family came in 1786. And just like Vito Corleone in Ellis Island, I have no idea what my last name is, because all they said was that we were from San Martino, which is my maiden name is DiMartino. So that's my story. Where are you from?
So you hit really close to my heart, because I am from a small town close to Naples, actually 70 kilometers away. It's closer to the Amalfi Coast than it is to Naples, but for people to know, it's easier to say close to Naples. So pure South. A very humble family. As you well know, GDP per capita is not that high over there. So we try to, we are happy with not much, to be honest. And I am sad enough to say I have left Italy for work. I went to the north of Europe, to Germany first, then to the Netherlands. But my heart is still there. I mean, I can't get around that. I visit there probably 4 or 5 times a year, at least, maybe 6. And married to a southern Italian lady, of course, because it can't be otherwise.
No.
Baking my sourdough bread and pizza from time to time.
Oh, I'm jealous.
And cooking, proper Italian stuff. It's people from the south of Italy are just very spontaneous. They're very open. They're warm, and they are just what they are. Nothing to hide.
Well, I think that I got all of what you described then from my grandmother's side. So when I go to Italy, I go straight to Florence. And it's just, it's like there's a magnet between me and Florence. I went as far as Rome on my most recent trip. I went a few months ago to Italy, and it was just, I was so happy that everything was still intact and that the people were still as warm and wonderful as they've always been. I love my home country. So humble beginnings. Your father taught you a story about humility. And without using the actual word, can you kind of quote him? I mean, we have young viewers. Alfonso, we have young viewers. So what was your father's wisdom?
Some background first. My father is a forklifter, working on a non-permanent, sort of temporary rolled contract every year. So it's really tough. You always have to hope they're going to call you back next year, or you are unemployed in a place that has a 40% unemployment rate. So good luck. So you use the past of the verb, but he still teaches me humility every day. And one of his best quotes is, okay, let me not try to use the literal word, but success tastes much better if you before have gone through some trouble, let me say like that. But he says, if you have eaten some
some fill in the blank, then success always
Not
tastes
very
better.
tasty stuff before, right? So if you have gone through some trouble in life and you have been toughened up by it, then normally when you are successful, it tastes even better.
I couldn't agree more. I mean, well, we both come from very humble beginnings. And in the United States, I say I started off in community college, and everybody kind of understands where I'm coming from. But I appreciate humility and people who make their way out of it and make their way. So you're the Italian dream. So talk me through what that bad taste was 7 years ago.
So basically 7 years ago, I was involved in a deadly car accident. I'm still here, so it's supposed to be deadly. It was a frontal car accident at a very high speed between two cars, which normally means you're dead. And I suffered a lot of injuries, was trapped into the car wreck for hours before the firefighters could bring me out of it. It's very intense. Still have goosebumps, to be honest, talking about it. And from there, a very tough journey started because I was lucky to be alive. That's true, but I had to endure years of surgeries, and we're talking like big stuff, trying to recompose bones, back bones, leg bones, and all of that for 5 years in a row. So we're talking like you did the first surgery to try and reconstruct. They fully opened your leg, and then physio, wheelchair, and all that stuff. And then 9 months later, you knew already you had to go through another one. So all over again. And with no certainty you're actually going to be able to walk at all after that, if not even to try and run and do some sports. But you had no alternative, right? So that's what the family teachings come useful for, because you can only try to fight in that situation. And also you're forced into it. You don't have a choice rather than to be humble and literally try your best, believe in yourself, do some hard work in physio, and maybe you're going to get there, plus some luck, which I had. So ultimately they fixed me, right? And that's what matters the most, because after a lot of fighting, 5 years, they managed together with me. And at the end of the day, I can now walk. And even look, the fact that I'm saying I can walk rather than run a marathon tells me that it's been, at the end of the day, good to go through that experience, because you start having a different perspective. Walking is already something. It basically humbles you, because you have no other alternative than to fight to get to something, right? And something is walking, and that something tastes even better if you have gone through some crap first, right?
Of course. And I mean, and when you think about the human being, the physiology, I mean, to us, to most people, walking is like breathing. It's something we just take for granted. And once you've lost that, so I completely, I mean, I'm amazed by your story. I applaud your courage. My father taught economics and finance. When I was a little kid, I used to read the Wall Street Journal, and I had no idea what it was saying. But I grew up with it. So you also grew up in the world of money and banking, finance, economics.
Yeah, we have some pretty similar stories. I hear, background. So I said my father is a forklifter. My mother works in a small Italian bank. She's the treasurer of that bank, which means a lot of BTP, Italian government bond future charts on your lunch table while you're eating your pasta when you are 14. And you're like, Mom, why are we looking at this thing? I mean, what the hell is that chart, and why?
Yeah, of course.
While we have lunch. And she's like, the BTP market never sleeps. And I'm like, what the hell is the BTP market? And so she will go like, BTP stands for whatever it stands in Italian for. And this is the Italian government bond market. This is the future that has as underlying. I'm like, stop there. Government bond future? What the hell are you talking about? And then, you get interested because she's basically as your grandmother, as you said before, a very typical Southern Italian lady with a lot of passion for what she does. And so very self-explanatory, as we from the south of Italy are sometimes. And, you get passionate about it. And plus, I was always curious, lucky enough to be since I was a kid. So ultimately, my journey in finance started when I was probably 14 to 15 with these lunch breaks, effectively.
So BTPs, let's go there for a minute because, it wasn't that long ago. I'm getting old, so it was like 10 years ago. We were kind of veering into the Euro crisis, and everybody talked about BTPs. Everybody. It was kind of like the subprime index that people would follow. Is Europe going to blow up or not? And the prism that you followed was that market. So go back 10 years, talk about that, talk about the Italian banking system and what's happened since then and what's not happened, I think more importantly, since then.
Great question. So basically, the BTP market was about to implode somewhere into late 2011, beginning of 2012. Because of the construction of the European monetary and fiscal system, right, which is very different from the US one, because while there is a European central bank that sets policy for 18 or 27, actually, if you want to enlarge it, different countries, every country is more or less free to engineer their own fiscal policy within a certain framework, which is the Maastricht framework and the European rules, but every country more or less can redirect resources and spend or do deficits or less deficits at their own will, which means that fiscal policy and monetary policy are definitely not coordinated at a European level, much less so at a country level. And so as well, countries joined the European Union under very different circumstances. So Italy always had a relatively healthy private balance sheet. The Italian private sector is very conservative, never got leveraged too much. There is not a leverage culture in Italy when it comes to the private sector. There is definitely one when it comes to the public sector. So Italy entered the Euro system with a pretty healthy private balance sheet, not so healthy public balance sheet. And other countries in the north of Europe, for example, I can make the example of the Netherlands, which is a very healthy country when it comes to public debt, but it has a very leveraged private sector that is, really indebted towards the real estate market, for example. It's pretty important here that the real estate market holds together in the Netherlands. As well, they have a lot of assets in the private sector when it comes to pension funds, private pension funds, which in Italy do not exist. So it's a very diverse setup. But the fact you enter this union under very different circumstances, and the fact that there is a very diverse fiscal policy, while one monetary policy needs to be applied to 18 different countries, leads to some difficulties here and there in Europe, and also some tough decision making. So in 2011, 2012, with the sovereign debt crisis, the so-called PIGS, so Portugal, Ireland, Italy, Greece, and Spain, were basically attacked by markets and trying to be brought on their knees. And well, back then, what we did in Italy was what we call lacrime e sangue, which is tears and blood policy. So austerity full stage. So effectively, Italy decided to punish its private sector, which wasn't at all leveraged. So they went even further into a deleveraging process in the private sector to try and transfer resources back to the public sector and convince investors that Italy could actually hold their ground, right? And this was a terrible blow to an already damaged Italian private sector that basically never got access to credit. And when it did, Danielle, it got access to credit at very expensive levels. Well,
plus, for viewers who don't understand the dynamic, maybe you could make it very simplified. The competitive advantage that Germany has compared to the manufacturing sector, which people don't appreciate how wonderful the manufacturing sector, how strong the manufacturing sector is in Italy, how deep the roots go. But maybe you can just explain kind of the dynamic with the euro and how that impacted well before 2011 the private sector in Italy.
Well, so basically the euro is one currency that is supposed to serve the means and the needs of 18 different countries in Europe. And Germany effectively has been accumulating surpluses as a result of the euro. The euro is a currency that is let's say, way too artificially cheap compared to what the Deutsche Mark would be. And the result of that is that Germany, which is an, let's say, export-oriented country, is able to lever on a currency that is intrinsically more cheap than the Deutsche Mark would be, effectively, and it's therefore able to export and to be much more productive, quote unquote, than other, especially Southern European jurisdictions in Europe would be, if they had their own currency, if they could devalue their own currency at their own needs. So effectively, the euro is way too strong for Southern European countries and way too cheap for Germany and some other Northern European countries that, as a result, are accumulating surpluses. And this is also leading to something that is not very often discussed about, which is target 2 balances. So there are different central banks in Europe, and they settle payments on behalf of investors and people within countries. So basically, there is a system where if I want to transfer money or buy or move my money from Germany to Italy, for example, I will have on my back, the Bank of Italy and the German central bank that will basically settle the payments between Italy and Germany cross-country, right? And when they settle payments, because there is one central clearing system at the end of the day, which is the European Central Bank, those payment mismatches will result in the so-called target 2 balances. So if money is flowing towards Italy on a net-net basis from Germany, then these target 2 balances tend to basically balance out. Otherwise, some imbalances are created. And when you have obviously a country that is able to accumulate much more surpluses than another is, then these imbalances in general tend to widen a lot. And when these imbalances widen a lot, this basically means that if Europe would decide to dismantle tomorrow, there would be Germany claiming some money from Italy to settle this imbalance basically between the 2 central banks, right? So it's a very weird system where Germany and the north of Europe are getting benefits of an artificial cheap currency compared to what it would be neutral for them to have. But at the same time, if they would decide to walk away, or Italy would decide to walk away, then Germany and other Northern European countries would be left with the bill to settle or to be settled from Southern European countries that those countries probably can't afford. So it's a very weird mechanism in here where you have winners and losers, but at the same time, you have an incentive scheme for Europe to hold together at the end of the day, both for geopolitical reasons and also because this weird system has been used for so long that it's now weird enough that the only geopolitically sensitive thing to do is to keep it together.
And yet we hear, especially in the Western media, that Germany is supporting Italy, and that's something of a mischaracterization. And I don't think there's a good enough appreciation of this. So,
well, the other thing I always try to uncover is people tend to look at the public sector only. That's the reference for market and economic commentators. They look at debt to GDP, government debt to GDP. Now, if you take, say, Germany, let's make the example of Germany. And then you take, together with the government debt, you also take the private sector debt. And most importantly, you take the so-called contingent liabilities. What the heck are contingent liabilities? Those are Germany going to KfW, that is their, let's say, government agency bank. So it's basically a fully backed development bank that lends to several entities in Germany, right? Now, the trick is that the debt accumulated by KfW is not incorporated in government bond calculations. So despite there is effectively an explicit guarantee, almost an explicit guarantee, the debt of this bank doesn't get calculated into Germany explicit debt to GDP, but it's only added bilaterally in a footnote, which is invisible, called as contingent liability. Now, if you sum up the private sector debt, contingent liabilities, and the government debt, you will end up at countries like Germany and the Netherlands having similar debt ratios to the countries in the south of Europe. And obviously, this debt is distributed in a different way, right? I mean, the contingent liability is an accounting trick, but private versus public, it's a very different distribution of this debt, right? And the other question you should ask yourself is how productive this debt is. And truth to be said, in Italy, it's not really productive. So when we incur in debt, most likely we use it for non-very productive long-term investments. And the countries in the north of Europe have done a bit more. But my point is, if you look at the whole picture, instead of only looking one side of the coin, the public or the private, and you count in the accounting tricks called contingent liabilities, the situation is not that different as mainstream media wants to picture.
No, it's not. And now I've learned something. I've learned that Germany has its own Fannie and Freddie, which is pretty incredible. And that's how they don't calculate public debt in the United States to include these two huge mortgage guarantors, and yet they have the implicit backing of the United States government. And that is a very well-known fact. So now I've totally learned something. Why then, if the private sector was not so levered in Italy, why do we hear about the oldest bank on the planet being at risk of going away? What's happened with the Italian banking system?
Yes.
I think we're going back to the BTPs.
Yeah. So the Italian banking system, I'm sorry, you asked that before and I forgot to reply.
No.
So the Italian banking system, Danielle, here we go. This is a very unproductive system. The incentive scheme there is even probably worse than the average incentive scheme in the banking system, which is pretty poor. But let me elaborate. So Italian banks have accumulated over the last 10 years a record amount of NPL as a percentage of their asset side. NPL is an acronym which stands for non-performing loans. Those are loans that are classified in accounting as, well, not performing according to certain standards. So if you're basically, if your borrower doesn't pay you back a full amount within X months, then you go into a certain category, then you move into another category if you are even less likely to pay, etc., etc. Now, the point is, how did Italian banks manage to get so many of these non-performing loans on their balance sheet, right? And there are anecdotal examples or empirical examples I can bring. Basically, the credit checks that Italian banks were doing up until 10, 20 years ago were almost non-existent. And on top of that, a decent level of corruption also plays its role here. So credit was channeled towards places where either there were very little background checks for creditworthiness, and or there were, let's say, personal interests in where to redirect credit, especially because the Italian banking system was extremely populated by very small local banks. Those very, very small local banks, in the Italian case, even in the north of Italy, I should say, there are plenty of cases of small regional Italian banks in the north of Italy that have defaulted because of this reason, or anyway have gone out of business. There was an incentive to try and redirect credit where it was convenient for people to redirect credit rather than where it was economically sound for the bank to direct credit. That's one. And then the lack of general credit checks led to a lot of NPLs on the balance sheet. And NPLs are toxic for a couple of reasons. The first is they get impaired. And when they get impaired, what happens is that you have basically to look at losses coming over the next 10 years. Are you going to amortize losses on your loans? And when you look at losses over the next 10 years, you as a bank will not be incentivized to extend more credit. It's a reflexivity problem. It's a scar on you. If you know that by lending over the next 10 years, after receiving regulatory scrutiny, somebody finds out you are full of non-performing loans, they force you to haircut and to face losses over the next 10 years, trust me, you will not lend money. And when you don't lend new money, even if people actually deserve it, you do not create new credit. You are not transferring to the Italian private sector. You are not giving them access to credit. And when you don't give access to credit, it's very difficult for people to participate in what I call the wealth illusion effect.
Yeah, I mean, if you don't prune a rose bush and you leave the dead wood on the rose bush, then you're not going to have roses. So, and that's what you're describing.
Yeah, and you know, if you then move to the north of Europe or to the US, access for the private sector to credit is abundant. It's extremely simple and it's abundant. And what this leads to is, for instance, mortgages. So if people want to buy a house that costs 500,000 euro, and they do not have the money for doing so, what they do is they go and ask for a mortgage, which is credit being redirected to the private sector by bank with a collateral behind. And if this credit is delivered with, a certain fluidity and the real cost of this credit, so real interest rate on mortgages adjusted for inflation, is actually low, people will have an appetite to borrow because their monthly installment compared to their disposable income is acceptable due to the fact that borrowing costs in real terms are pretty low and the real salaries perhaps grow a bit over time. So they feel comfortable and they buy the 500,000 euro house. And then if you expand new credit at lower real interest rates this time, as mortgage costs, you tend to go down a bit in your jurisdiction and salaries increase a bit, the next guy can buy it for 550. The next guy can buy it for 600. Well, that's basically the wealth illusion effect we've been creating by lowering real borrowing costs on mortgages in this example, so that basically the value today, the net present value of the asset you're buying the house, can be higher on paper as your borrowing costs have gone down, your real salary has gone up, so you can afford to buy a more expensive house. The guy who has bought it before you has just printed 50 or 100,000 capital gains, and so on and so forth. Well, in Italy, none of this wealth illusion effect has gone on because the private sector actually doesn't get access to credit creation in the first place.
Well, and it's interesting you bring that up, because here in the United States, we have the largest generation here, the millennials. When you bring up the subject of buying a home, they think you're telling them a bad joke, because even with mortgage rates at record lows or near record lows, they still can't make the payment work. So they've just factored it out of their future dream, and they spend all of their income as opposed to trying to save up to buy a home. And at the opposite end of the spectrum, Italy has the most undervalued residential real estate sector in the world, practically. And this is I'm going. I need to buy a house in Italy. This is on my to-do list. So on my to-do list, where I need to retire. But you see how access to credit can make the pendulum swing too far to one side, which is the case in the United States, but much more so in, as you say, the Netherlands, Australia, New Zealand, Canada. And I don't think people have a good enough appreciation for the risk in these countries of a balance sheet recession, yes, which is what the United States suffered after its subprime crisis, and balance sheet recessions don't end quickly.
No. And there is a fantastic book on balance sheet recessions, which I think it's even called Balance Sheet Recessions by Richard Koo. And it talks about the Japanese balance sheet recession. Mm-hmm. And I always bring Japan to the table because they have basically tried this monetary fiscal experiment already 20, 25 years ago. And of course, there are differences between Japan, the US, and EU when it comes to current account balance, for example, or a certain culture in their society. But big picture, what they had done back then, Danielle, is effectively create credit like there is no tomorrow. So there were a concerted effort, both from banks and from the government of Japan. The government printed deficits year after year, which means they effectively transferred resources to the private sector. It can be in any forms. They either cut taxes, so people have more disposable income, or they send, stimmies to make it US-wise. They didn't send stimmies back then, but it's just to say the government basically redirect resources to the private sector, but the private sector also pays a credit spread on top. So when you ask for a mortgage, you don't get the 30-year treasury yield, you get the 30-year treasury yield plus a credit spread. So if real interest rate on a risk-free turn close to zero and you overlay a credit spread of 1% on top, let's say you're paying 1% real borrowing costs as a private person. Well, if you're levered up to here and your real wages are not going up, I'm sorry, but the whole castle just comes down. And that's what happened in Japan. And then you're right, because it's balance sheet leverage that leads to a balance sheet recession. The balance sheet recession is extremely difficult to fight because the private sector gets hurt. Banks learn that extending credit over credit to the private sector leads them to have big trouble. So they become conservative and they act cyclically the wrong way. So actually they start to behave pro-cyclical rather than anti-cyclical, which means when the balance sheet recession happens, banks do not step in to lend. They actually close their doors and they're like, sorry, guys, you already messed it up once. We're not going to do this again. And the government tries to offset sometimes and do some counter-cyclical fiscal policy, but also cannot do all the heavy lifting itself. It then becomes a self-fulfilling prophecy. And then as you don't extend new credit and the private sector is going through deleveraging, the deleveraging becomes more severe and it has long-lasting impact on unemployment and et cetera, et cetera.
Yeah, no, I mean, you perfectly describe an adverse feedback loop. I mean, to a T. Yeah. And the only exception to the rule, the sole exception to the rule, is if you have a reserve currency status. And that is, I would argue, why the United States was able to come out of its balance sheet recession. I mean, if you compare it to how many lost decades in Japan, but the United States was able to come out of its balance sheet recession because it has the world's risk-free treasury. It has the world's risk-free security. But here we are today, and we're talking about sea changes. At least I'm talking about sea changes. So let's go down all the way to your philosophy, the macro compass. What is your compass? I'll tell you mine first. The MOVE index to see what volatility is in the bond market and the yield curve. That's it. People are like, if you were on a desert island and you had a Bloomberg terminal with only two functions, ... go, it would be the yield curve and the MOVE index. And that would tell me everything that I needed to know about the US economy and how vulnerable it is. What's your compass?
My compass has two metrics, and it's also pretty simple. On the x-axis, you have the credit impulse. On the y-axis, you have the monetary policy stance relative to neutral. Okay, so maybe with a Bloomberg terminal, you won't do it unless you created your functions, but we can still get there with two functions.
Well, we can get there because I know you and I get your graphs. And we'll pop one up right here when you send it to us. Anyways, continue. Sorry.
So, credit impulse, the first one, and the most important. Our system is created on credit growth. As I said before, we feed a wealth illusion. We bring forward future consumption by borrowing more and more. Why do we do that? Because if we wouldn't do that, we would have to revert back to structural trend growth. Trust me, that's bad. That's the result of working age population growth and productivity. Working age population growth is bad because simply we are not making kids and we're growing older. So sorry, but actually, the labor force is shrinking all over the world, and the US is just barely above 0% thanks to some immigration. That's the first part. The second part would be productivity, which is also, stagnating around 1% a year, 1.5% a year. So if you wouldn't create any credit, you would grow at a whopping amount of about 1%, maybe tiny less. Wow. Just ask yourself which politician or policymaker would accept that trend growth to be, re-elected or to be a trend growth which is socially acceptable. Not many, especially since 1971, as we have left the gold standard and we have this new fantastic system. It's a fully elastic credit system. You create credit or you print deficits if you are the government. You have no fixed price at which people can take this newly created currency and convert it to something which was gold back then. There is no fixed price to convert anything against anything. There is an embedded, let's say, peg, as I call it, because if you look at, of course, all asset prices against the currency itself, they have all gone up, which is a result of, this credit creation obviously gets then recycled into assets, but that's a soft peg. Between 1944 and 1971, this was a hard one to respect, which obviously, guess what, at some point didn't work anymore, and we had to abandon that. Back to the credit impulse. We therefore create credit. It's a feature of the system. It's not something we want to do. It's just we do it because it works. And when we create credit, the reason why I don't look at credit creation is because it's a feature of the system. What I look at is the rate of change of this credit creation. So are we accelerating? Are we pumping credit at a fast pace, or are we pumping credit at a slower pace? If we're pumping it at a very fast pace, I created this G5 credit impulse metric. It's a prop metric. You plot that you give it 6 to 12 months time lag. So you first plot that, and then you say, credit impulse, tell me what earnings are going to be in 12 months. Tell me what if commodities are going to overperform gold or not. And he tells you. I'm just kidding now, but it does a very good job at predicting where things are going to be in terms of earnings, economic activity, asset performance. It's very simple. If you pump credit very fast to the private sector, you give it 6 months, they start using it, earnings go up, cyclical stock sectors perform, industrial commodities perform, EM performs, etc., etc. You do the opposite, you reverse the cycle, you give it 6 months, and there is no new credit flowing through the economy, and bonds perform, and inflation comes down, and earnings come down, and defensive side of the sector defensive sectors of the equity market actually overperform. So that's the first one, the first metric. And the second one is the relative monetary policy stance, because as you said, both the yield curve and implied volatility in bonds is extremely important. I compare that to neutral, and neutral is my estimate for, well, there are models out there too, but it's a model estimate of what can the economy take in terms of Fed funds rate to run at potential. You know, it's of course not observable. You need to measure that.
Right.
And then you compare federal funds rate and where they're going as well. So it's not only the absolute different or the relative difference between Fed funds rate and the equilibrium rate, but also the pace of change. So how fast are we signaling tightening or easing to the market? That's also very important. You put these two metrics on a compass and you obtain 4 simple quadrants, and you can get an asset allocation indication. That's it.
So, but if I've been reading you correctly since I discovered you, which was a great discovery, the law of diminishing returns plays a very big role in the magnitude of the credit impulse. So the impulse has to grow as a factor of time. It cannot just, you can't just ramp it up to 100 miles an hour and leave it there. You actually, the next time around, you have to drive at a faster speed.
Yes. It's basically Dr. Lacy Hunt.
Lacy Hunt.
One of his main theses. He's perfectly right. The way I illustrate this to people who follow me is I take the US debt to GDP, I invert it, and I say, okay, let's look at the last 20 years, for example. And then you look at 30-year real interest rates, and you plot these two series. So remember, you inverted that to GDP, which means if it goes down, then if the correlation holds, real rates also have to go down. It's one-on-one. It's just one-on-one. You just plot it. But again, it's not because I discovered something new. It's because that's how it works. If you need to pump additional new credit at a faster speed to obtain a lower and lower return when it comes to GDP growth and earnings, this credit needs to be cheaper and cheaper for the whole system to hold together. And that credit is cheaper only if risk-free real interest rates are going down and credit spreads are very tight. That's the only way you can do that. So look at the financial condition index of the Fed. I mean, what do they have in there? They have the curve shape, what you look at, real interest rates, credit spreads, equities. Mm-hmm. Does it surprise you? Not much. So this financial condition index needs to remain low, and the ability for it to basically become less ease or tighten up is lower and lower. The ability for this financial condition to reprice in a more restrictive way is lower and lower as time goes by, because the entire system becomes more and more leveraged.
Well, and I think that's something that Jay Powell discovered the hard way in 2018, 2019. He was endeavoring to normalize to a Fed funds rate that was impossible. That he wanted to get to 3%. And he found out that 3% would break the system and that he couldn't get there. But if it was his predecessor, Ben Bernanke, it might have been 4% for it to, and now here we are today trying to figure out, how much latitude the Fed has, despite everybody's talking so big about 8 interest rate hikes or 7 or 5 or 4 in 2022. I'm like, I'll believe it when I see it.
Yes. Well, the other chart that I have that is pretty interesting to see is if you look at what the bond market has been telling you the Federal Reserve terminal rate can be. So at the end of each hiking cycle, projected, say, 4 to 5 year forward, that was the average length of a hiking cycle, let's say 4 years down the road. What was the bond market telling you the terminal rate at the end of the cycle could be? And then you look at this chart, which I plotted. We can try to stream it on. So it's like, okay, in 2013, this was 4%. Cool. In 2015, I think this was 3.5%. In 2018, when Powell said we are a long way from neutral, way to go, the bond market was telling you, I'm sorry, but it's probably 3%. Do not try that much more than that, or that's not going to work. Okay, cool. Now, the bond market has been telling you consistently, you can't even make 2%. And why is that? Because the level of private and public sector debt in the system has increased materially, while the capacity from private sector especially to generate structural cash flows, earnings, wage growth that is able to service this additional amount of debt is just not there. Well, it's there, but to a very little extent. So the only way for the system to hold together is if its terminal rate is lower and lower and lower. So there is no regime change. I'm sorry, but every time in my career, I've heard this probably 5 times already. Mm-hmm. So I plot third-year government bond yields. I put them in a channel. It's a downward trending channel for a good reason, which is the one I'm explaining. And then around this trending line, we have some of these, these curvatures and these cycles, right? And every time you reach the top of the band of the very clearly downward trending band, you hear that there is a regime change. It's either the commodity super cycle, or it's the taper tantrum, or in 2018, we discovered that the US economy can deliver 3% sustainable growth forever, or, you name it. I've heard so many of these regime changes. And every time as you hit what basically the bond market is telling you, there is a lower and lower terminal rate. And if you hit the band towards the terminal rate, you have to reprice down. There is no other way. Otherwise, new credit creation is not cheap enough for the system to lever up again and produce a new wealth illusion effect that lets me believe the house I bought in the Netherlands is a good investment, despite I paid it 40% more than a few years ago, because I'm borrowing at 150 basis point lower real rates than the guy did 10 years ago. That's actually the only difference. Plus, real wages go up, but by this. The leverage effect of lower borrowing costs is so large that it cannot reverse.
So I'm going to throw this out there. I think that the difference between where we are today and where we were in 2015, 2016, I think you can fill in that blank with one country, China. And in 2015, 2016, the world was in an industrial recession. I would argue that by the time your interview airs, we will be recognizing that we're in an industrial recession, and that could be a global phenomena. But this time, I don't think China comes to the rescue. And I think that some of your work has illustrated this.
Yeah, so China, and you're perfectly right, Danielle, China has been the engine of credit creation throughout my career.
For the world.
Yeah. It's impressive. If I decompose my Chinese credit impulse for the percentage of who is delivering what all over the world in terms of credit, China has been the overwhelming majority of what's been delivered in terms of new credit. It's been gigantic. I cannot define it otherwise.
Well, I'm going to interrupt you for 1 minute, and somebody on YouTube just sent me a hate mail, I promise, just because I interrupted you. I don't think most people in the world know that the 4 largest banks on planet Earth are in China. They're like, no, that's got to be JP Morgan Chase. And I'm like, actually, no.
No. And this is so important, Danielle, what you're saying. The other thing to understand is that the Chinese system is completely different from ours. Banks create credit every time they extend the loan. They literally print money, all right? So this is the commercial banking system telling you, you don't have money to buy the house, here you go. And I'm not taking a deposit that I'm lending. Every time I lend, I create a new deposit. That's how the commercial banking system works. In China, they have the power to say, a state-owned huge bank, now I want you to expand credit and to X, Y, and Z sectors. Please, tomorrow. Actually, without the please. I think they do it without the please.
I think they do it at gunpoint. So different, yes. Kind of Italian.
Just do it. And it's done. And it's done in the size they want to the sectors they want. That allows them to turn on the credit creation taps extremely quick. And when they decide to do so in size and quick, the result is very clear. The Chinese private sector get access to a huge amount of newly created credit. They spend it both on domestic and on external assets. And therefore, the whole world gets lifted by this huge tide that lifts the whole boats. 2015-16, your example, perfectly on point. They created a huge amount of credit. 2017-18, so as I said before, you have to leave it a little bit of a time lag for this credit to feed through the economy. 2017, strongest concerted global growth we had seen for 5 years in a row. Even Europe managed to grow 3% in a year. I mean, real GDP-wise, that's incredible. For us Europeans, that's awesome. Today, the situation has been very different. China has not been extending any meaningful credit on a credit impulse basis, on a rate of change of credit. They have actually decelerated pretty aggressively compared to a few years ago, and they have deleveraged the private sector very clearly. Xi Jinping has gone after Jack Ma, the entire tech IPO sector, online education sector, and now the property sector. Mm-hmm. So he has basically been saying, this sector, private sectors, sorry guys, you need to deleverage for a bunch of reasons, but I will force you to deleverage. And Evergrande has been the last example. Now, this deleveraging is pretty intense, and we will see the negative effects of this at least throughout the first half of 2022. So people that are talking about the crack-a-boom in nominal growth this year, sorry, I can't see that. The US is not printing new credit since March 2021. This is the last large fiscal stimulus. Banks are very timid in lending. They have restarted a bit, but not much. Europe, as always, is useless on credit creation. But China, the monster component, has been deleveraging for the entire 2021. So in the first half of 2022, we are likely to see some disappointment in earnings and nominal growth data. And I'm also going to argue that, yeah, probably this inflation is going to come down pretty aggressively. My models point to numbers that by September 2022 are going to just help out the Fed not to over-tighten, because the nominal growth and the impulse of growth and inflation throughout the economy is going to slow down so much, I believe, that they probably will just be forced to hike much less than what the bond market is expecting. As a result, I went out yesterday and I said I am long bonds. So I bought 10-year treasuries at 1.85%, which might seem crazy, but to me, a long-term medium investor, I mean, maybe they go to 2%, sure, but I can hardly believe that we're going to see anything higher than that.
No, and I think that if there's anything that people are not paying close enough attention to, it's the magnitude of the fiscal impulse in the United States was so big that it became its own global phenomena. But we're in a very contentious election year in the United States. So the follow-through is not coming, and United States politicians sound like they've lost their minds because they're saying that the Fed needs to tighten and tighten tomorrow. And yet we know, looking through the lens, especially because of China and what it's not doing for the global economy, we know that there's a slowdown coming. It's just people aren't recognizing it because they're seeing what the CPI print was, what this consumer price index was last month, or what it's going to be next month because of car prices. We're in a terribly tumultuous time, I think, right now, and it's very difficult for people to make calls like you made, but I think you're exactly right.
Well, to be honest, Danielle, I am also a very honest person. So if I'm wrong, I always put stops to my investment ideas. I can be as right and as wrong as anybody else. I always say I'm right 53 to 54% of the times. That's what I'm right for. As long as I'm right big times and wrong stopped out little, then that works for me. But to be honest, I always try to call what I see, and my credit impulse, global credit impulse metrics, as you said, went through the roof in 2021 because the US did so much. it's gargantuan. I've never seen something like that. From China, I've seen it occasionally, but from a developed market, jurisdiction, I've never seen so much credit being pumped.
No, I mean, we're talking about $10 trillion here. I mean, it's a big figure.
Government went ballistic, absolutely ballistic. And private commercial banks actually also lent on top because they had government guarantee for some of these loans. So they felt, enticed to lend to the private sector because, the government was backing the credit losses in case. So who cares? We can lend out, right? The combination was extremely, extremely strong. The problem is that people like the fiscal sugar rush, they forget there is a credit cliff too. And now we're facing the credit cliff and China is not picking up the tab as we're used to see and we saw in 2015, 2016. As a result, my model has been screaming since basically mid of 2021 that the impulse of growth, and I always talk about impulse. So of course we're going to grow this year. It's not going to be a recession, but is it going to be a strong above trend growth with a strong inflationary component at the end of 2022? I can't see that for sure until the first half of this year. I think we're going on a trend basis down, both in real growth and in inflation.
All right, so I might actually be more bearish than you, Alfonso, believe it or not, just because I look at the yield curve and the difference between the 2 and the 10-year basically as the amount of runway that the Federal Reserve has to tighten. Whether you're talking about running off the balance sheet, I mean, there's an enormous amount of U.S. Treasuries coming due in 2022. So even if they just let the balance sheet run off, it's going to be monumental in terms of the equivalent of tightening, in addition to the fact that they want to start hiking rates. We'll have to wait and see. You're right. I think we'll know a lot more 6 months from now. But being somebody who wrote a book that was, the subtitle was Why the Federal Reserve is Bad for America, there was actually a central banker that I liked even less than American central bankers at the time, and that was Mario Draghi. Okay. But I have to say, as a prime minister, I don't know. I think I like him better. What about you?
So I think Draghi has brought some institutional credibility to the prime minister office in Italy. We have had some difficulties in asserting that on a G10 basis, let's say, over the last decade. And Draghi effectively is a person that understands what's wrong about Italy. He deeply understands that. And what he has been trying to achieve is using the European Recovery Fund sources, which is basically a great opportunity for Italy because this time we actually get some proper funding at cheap levels from the European Union, backed by the Netherlands, Finland, Germany. So there is some fiscal union exercise going on, initial baby steps, but it's something. And Draghi has been tasked to try and use that money as better as he can. And obviously, he has been relatively successful so far in implementing projects because he understands that this credit coming from the EU needs to be used for productive outlets. So he has been investing in digitalizing, for instance, the public administration in Italy, in making sure the legislative processes are sped up because it's really slow in Italy, foreclosures and all of that. Obviously, all these policies should be able to enhance productivity and long-term growth in Italy and attract some foreign investments, which is also lacking a lot in Italy. He's been definitely doing a decent job. And it's to me, just fresh air to see a prime minister that understands what Italy needs over the long term. And his advantage, by the way, is that he doesn't want, in my opinion, nor needs to be re-elected in 2023. He literally cares about long-term benefits and reforms that Italy needs rather than, getting some short-term cyclical growth boost so I can be re-elected in 4 years. So I think it will really benefit Italy in 5 to 10 years from now. Well, I can't believe that. I mean, as you say these words, but there's a parallel, and that's that Jay Powell does not need his job as the chair of the Federal Reserve at all. His net worth speaks volumes, and he really is there just to serve his country. So for better, for worse, at least he's holding the line on socialism for the moment. And that's the best we can say. And we can say Mario Draghi makes a better prime minister than he did as central banker. I would love to revisit a year from now
and maybe you'll have a bit different background. Heck, I'm in Italy in October. Let's try and make it happen in person. That would be so much fun.
You shoot me a message and I'll make sure that we see each other. But are you in Austria or are you in Italy? And I always make this joke. If you're going to Milan, that you're in Italy, more or less. Are you in the proper part of Italy, so south of Italy, or?
I tend to fly into Rome, so there you have it.
Rome, okay, I can do Rome. That's done.
Wonderful. Well, I want to thank you for your time. I really appreciate it. I recommend everybody follow you on Twitter. You're just amazing, and the newness of your analysis is something that is so refreshing. So I highly recommend following you and understanding your work. You put it out there. You do a great service to the future of financial literacy. Thank you for your time today.
Thank you. Actually, education is my biggest thing here, just trying to deliver the knowledge to people. And it's been a pleasure to be here with you. Great interview. Thank you.
Thank you. Grazie.
Prego.